All right, guys, we're moving into our second part of the chapter, the second lecture for chapter 11. And actually, I want you to actually look at your screen for a moment. And I would like you to write this tree diagram that I have written up here in your notebooks, because it is something that we are going to uh, be talking about in this video. So take a minute, pause your video. I'm going to go ahead and pause my video for a minute. So pause your video, write this down. It doesn't have to be big. It doesn't have to be on a big sheet of paper. Just put it up at the top heading or whatever. And we're going to discuss this tree diagram here in a minute. So go ahead and take a minute, write that down so you have it, because it is something that is not in your notes. And I do want you to have it. And then we are going to proceed in our lecture with our chapter 11 PowerPoint slides, and we are going to go right to slide number 5. So go ahead and copy that down and pause the video so you can copy it and bring it over and then open up slides. Slide number 5, chapter 11. All right, going to slide number 5. 5 is alive. Here they're talking about stockholders of components of stockholders' equity. Now, you could either do two things. One, you could pay attention to the piece of paper that I just gave you and the little bit of notes that I wrote on there. Or two, you could go ahead and read this slide. Now, my experience being 8 years in here at SUNY Delhi now, and this being my beginning of my ninth, is that college students hate reading. Just plain and simple, they hate reading. So, hence the reason what I call my tree diagram, as you see in your picture, okay? So if you follow along with this slide to your tree diagram that I had pictured up there for you, you'll see that it all jives. So the first thing, it says under the first component of stockholders' equity, authorized shares are the maximum number of shares that the corporation is allowed to issue. That means the maximum number, that's the highest number of shares they can issue. Now, a company is not required, or that's what they're authorized to issue, yes. They are not required to actually sell every share that they have the authority to issue. Most companies do not sell all their shares. And there's multiple different reasons for that. A company, if they're selling shares of stock to get some capital to, let's say, reinvest into their warehouse, and they feel that they need $500,000 to do so, they'll sell enough stock to cover that $500,000, so that this way, if they need more, because every project in the world seems to go over budget, kind of like Bluestone down there at the golf course was over budget by like $2 million or something like that, and I forget what the number was. But again, most projects are underestimated, which means they come in over budget, which means they need more money to complete those projects. So in this case, if they sold all their shares and only got $500,000, they'd be SLL. They wouldn't be able to raise any more capital. The fact that the example problem that we have in slide 3, and also the numbers that I've put on your tree diagram there, which correspond with slide number 3, just so you know, you can see that they were allowed to issue 60,000 shares, but in actuality, they only issued 40,000, which allows them to have an extra 20,000 shares to go ahead and sell at a later point, or hold on to, or whatever they want to do with them for that point in time. That's why you see the 60, if you look at your tree diagram, it goes from 60,000 to 40 and 20. All right. So authorized is the top number, the maximum number. The next number you get to is issued shares, represent the number of shares that are sold or otherwise transferred to stockholders. So that's what's been sold. So out of those 60,000 shares of common stock from slide number 3, I believe it is. Yes, slide 3. They have issued 40,000. Well, obviously, if they've issued 40,000, there's a number that is unissued, which is how we get your 20. 20,000 plus 40,000 equals 60,000. Now, the very last part is, if you look at your tree diagram, you'll see that under the issued shares, it breaks up into two more categories. Okay, those two categories being the shares that are outstanding and the shares that we considered what we call treasury stock. Now, keep in mind, treasury stock is stock that the company buys back of its own stock, which means in this case, or this example on slide 3, there is still 36,000 shares being held by people outside of the corporation. Okay? So those 36,000 shares are what we consider to be outstanding. Okay? We do not own them. Somebody else owns them. And that's the purpose of that. So the easiest way to go about using the tree diagram to figure out, which you will have to do later on in this chapter, is it's used to figure out the number of outstanding shares. Okay? If you were to go back to slide number 3 and you take a look under common stock, now this is the common stock portion. If you go under the common stock situation and you read the narrative there on slide 3, you'll see under common stock, it says 60,000 shares are authorized, 40,000 shares are issued, 36,000 shares are outstanding. Okay? And again, just like I told you on the prior video, 40 minus 36 gives us 4,000, which is equal to the number of shares that we held in treasury. Same scenario as your tree diagram. I just know that most students are better off learning visually, as far as, in this case, as visual as possible with the tree diagram that I've given you, as opposed to reading all of slide number 5. Slide 5 is all narrative, which college students, and I can vouch for this when I was taking master's courses, I overlooked those types of things. So I try to get these things down as much as possible and make them easier for you guys to handle. Now, the next thing I want to do, since we're talking about shares of stock and issuing stock, again, keep in mind the purpose of issuing stock is to get capital, meaning to raise money. Whatever the company is planning on doing with the money is fine, but the reason behind we issue stock is to attract investors, and attracting investors brings money into the account, and to use that money for whatever purposes we need to, whether it's continuing day-to-day operations, which is what a lot of companies are doing right now, just because of the whole COVID thing. A lot of companies are shut down. They're not running at full capacity, if they're running at all. We see that throughout New York State into the Midwest, where things are getting a little hotter out there. New York State, one of the keys of Midtown Manhattan there, or Manhattan, I don't know if it's Midtown, but whatever, Times Square area, all the Broadway shows canceled till next year. I don't know how many of you have ever traveled to New York City for a Broadway show, but it is an experience. It's a lot of fun. I was never a Broadway fanatic until I met my wife, who's from Queens. So, unfortunately, those types of companies are trying to get by with whatever money they can get. So this is one way for them to go ahead and to try to survive this COVID lockdown. So now what I want to do is I want you to jump to slide number 7. And slide 7 and 8, we're going to be jumping back and forth quite frequently between. And it's very important for you to pay attention to this video and pay attention to the slides. So please make sure that you have your slides open and that you're ready to work with them. You should already have them open, so I should be being a little bit repetitive at this point. But here's the same type of situation as we did in chapter 10, where we issued bonds payable. Well, now we're going to be talking about how you go about setting up the journal entries for issuing stock, preferably common, or mainly common stock. We're not going to issue preferred stock. We're going to deal solely with common stock. So some terms that you're going to need to know and terms that you're going to need to make sure that you understand are going to be coming up here. So please make sure you follow along. All right, slide number 7. It says issuance of common stock, okay? We're going to be issuing common stock in hopes that people will give us cash in return for that common stock. So just without even going any further, I want you to analyze your transaction. Issue common stock for cash. Now you say to yourself, and the same thing I do with my financial classes is the following. Cash is a what type of an account? And this is where I want you to think back to your ALSDRE. Cash is an asset, and assets go up with a, now here's where I want you to think of your AD and LSR. Assets go up with a debit. So in other words, cash is going to be debited. Now the next thing is we're issuing common stock. Okay, we're going to give people common stock. And that is a stockholders' equity account, which is part of the losers. And once that is part of the losers, that means that account goes up with a credit. Okay, so whenever you're issuing stocks, you know that your debit is going to be the cash. Okay, your debit is the cash, and one of your credits is going to be to common stock. Now, we will have situations the same way as we did with bonds payable, where you will have somebody who's paying for more than what the stock's par value is. You'll have the situation where somebody's paying less than what they said, what geez, now I lost my train of thought. You can sell the stock for more than what the par value is, or less than what the par value is, or exactly what par value is. It's the same type of scenarios that we had as we did in bonds payable. If we sell it for more than what the par value is, that means we're doing a sort of the same thing as a premium. If we sell it for less than the par value, then we're pretty much selling it at a discount. And then if we sell it at the par value, then we're selling it at a face value. So common and preferred stock may or may not. Okay, now here's some key points that I need you to pay attention to. Common stock and preferred stock may or may not have a par value. Keep in mind, par value is an arbitrary number assigned to each share of stock. It is literally made up. It's not a number that has any bearing other than to complete the beginning journal entries. Okay? It is a made up number. So please do not try to, ask me, where does par value come from? It's a made up number. It's going to be given to you in your questions, but it is still a made up number. It is not, there's no rhyme or reason to why a par value stock has a certain price. Okay? So with that being said, any amount received in excess, okay, and that means any amount. So let's say we have a par value stock of $2 and we sold one share for $4. That would give us an excess of $2 per share. That excess amount is going to go into an account that we're going to call APIC, additional paid-in capital. Okay? Now, additional paid-in capital is if a stock is purchased for more than the par value. Okay? Now, another term that we have to pick up for this section is the word stated value. Now, whenever we're talking about issuing common stock, I need you guys to get in the habit of saying par value is the same as stated. Stated value is the same as par. So when you're doing a problem like this, and I will go through a problem and I will put up a YouTube video on a problem so that this way you can follow right along. These are pretty simple journal entries. If there's no par, then you look for the word stated. If there's no stated, then you look for par. If there's neither one of them, then that makes it very, very easy, because that's the equivalent of having a face value bond entry. Okay? So what I mean by that is I want you to flip to slide number 8 for a minute. And when you get to these slides that have templates on them, the templates are there to help you. The templates are there for you to follow along. Literally with these templates, all you need to do is to fill in the blanks. So you're going to rewrite the journal entry and fill them in. It's not as difficult as some of you guys are going to make it out to be. Okay, so just give me 1 second.
No, you were supposed to just write the numbers.
Okay, so now if you go to slide number 8, it talks about common stock journal entries. Now, I mainly want you to pay attention to the first two. The ones that are in bold, it says sale of par value common stock, and then sale of no par value common stock. Now, the first entry is where we would be selling the stock for more than the par value. Things to keep in mind. Number one, par value is the same as stated. Stated is the same as par. So again, if you're selling stock so that you receive cash in return. So thinking back to your rules, cash is going to be going up with a debit. Common stock is also going to be going up, but that goes up with a credit. So keep in mind your ADE and LSR rules. So cash goes up with a debit, common stock goes up with a credit. Now, the cash you're going to figure out in a minute. And the best thing that I can tell you to do is, and this is how I handle journal entries, is I always write down the accounts and where they go first. I don't necessarily write in the amounts of them right away, but I do get my journal entry set up. So I know cash is going to be a debit, and I know common stock is going to be a credit. So I write those two account titles down right from the get-go. Now, it's easier if I give you some just arbitrary numbers to deal with. So what I've done on this piece of paper is I've given you some facts that I want you to follow along with. So just go ahead and copy down the facts on the piece of paper that I'm going to give you and come back to me in a second. So hold on 1 minute while I change the paper. All right, so if you guys can quickly jot down the information that I gave you on the sheet of paper that's on your YouTube video screen right now, you'll see that this has 60,000 shares authorized. We're selling 32,000 shares, and we're selling them all at $9 per share. Now, the three different journal entries you're going to have to write is A, B, and C. So the first one is A. So it says sold shares, no par or stated. B says sold shares, par is $3 per share. So here we have a par, but we don't have a stated. And then letter C says sold shares that have no par, but has a stated of $2 per share. Now, I just want you to jot that information down. So pause the video, jot that information down so that when I go back to the next slide, I'm going to use this information as a way to fill in the numbers for you so that you can follow along, so that you'll be able to do your homework assignment. So just pause your video real quickly, jot down that quick piece of the information, and then go back to slides, and preferably slide number 8 in chapter 11. All right, so now that we have that information, what I want you to do is take a look at the very first set of journal entries that you see up there. And it says sale of par value common stock. Now, we know that we're going to be selling common stock to get cash. So cash is going to be going up. So we're going to debit cash. We know that we're issuing common stock, which means the number of common stock is going to go up. So that's going to be a credit because that is part of stockholders' equity. Now, those are just basic rules from financial. That's the ADE and the LSR. I can't say that enough. So the first step that you need to do, so let's take a look at letter A. And letter A states that we have sold 32,000 shares that have no par or stated. Now the key here is that we sold those shares for $9 a share. So once you've written down cash and you've written down common stock, we'll start plugging in the numbers. So in your calculators, if you take 32,000 shares times $9 per share, that means the amount of cash that we're going to receive is going to be $288,000. Okay, so you're going to debit cash for $288,000.
Mr. Owen, can you help me real quick
Now,
before you guys
when you're doing the common stock, it says number of shares in parentheses. Now, this is something to pay attention to. The parentheses will give you some helpful hints. In parentheses, it says under common stock, number of shares times the par value. Now, in this situation A, we don't have a par value. So then what you need to do is you need to look and see if you have a stated value. And under A, there's no par or stated. So now we are at a conundrum because we're not sure what the heck to do. But I do want you to go back to slide 7 and take a look at the very last bullet on slide 7. If no par or stated value is set, the entire amount received is credited to common stock. So if we go back to slide number 8, we know that we just debited cash for $288,000. That means we're going to credit common stock for $288,000. That is only going to happen if we have no par or stated value given to us. So if you look at the problem, Part A has no par stated. So that's going to be the equivalent of what we did for face value when it came to a bond payable, because your cash is going to equal your common stock. Okay? So that's an easy one. Now let's move on to letter B. Letter B says we sold shares, meaning the 32,000 shares. We still sold them at $9 per share, but now it says that the par value is $3 per share. Okay, so let's go back to our slides and you will see. Let's figure it out. Well, we're selling shares of stock, which means cash is going to be a debit. We're increasing the number of common stock outstanding, so that's going to be a credit. And now let's figure out if we actually can get this to work. We know we're selling 32,000 shares at $9 a share. So the amount of cash that we're going to receive in this case is $288,000. We've already figured that out. That's 32,000 shares times $9 a share. Now let's figure out the common stock credit. That says to take the number of shares times the par value. So we're selling 32,000 shares, and letter B said that our par value is going to be $3. So if you multiply 32,000 times 3, you will come up to what should be, and I'm doing quick math in my head, $96,000. So at this point, you've got 288,000 on the left, and you've got 96 on the right. Now, our rules always have stated since day one in accounting that your journal entries always have to balance. Okay, they have to balance. So in this case, we need another account to put in there to go ahead and get the difference to make sure our account balances. So that's where the APIC account that we spoke about earlier comes into play. You will write, and you could abbreviate, APIC, additional paid in capital, and the type of stock that we're working with is common stock. So you're going to do APIC-common stock. And there's two ways of figuring this out. There's the easy way, and then there's a little bit of the harder way. The easy way is just take 288 minus 96. So if you do that, your additional paid in capital amount would be credited for $192,000. That's the easy way. Okay, and whatever way you go about figuring it out is fine. I don't have a preference. And the easy way is the very first set of parentheses that you see there where it says additional paid in capital, common stock, parenthesis, cash minus common stock. The other way is a little bit more difficult, and it would be a lot easier to explain that to you in class. So really, I'm just going to disregard the second set of parentheses under additional paid in capital, and I just want you to do the cash minus common stock. Okay, so your journal entry should be for part B, your journal entry would be a debit to cash for 288, a credit to common stock for 96. and then another credit for additional paid-in capital, or APIC, and that credit amount would be for 192. Now, once you add the 192 and 96 together, that gives you the 288. So you know your journal entry balances. So you're fine. No harm, no foul. It balances, you're good to go. The next thing, if you flip back to your questionnaire there, letter C says you sold 32,000 shares for $9 a share. So we know what that's going to be. This time it doesn't have a par value, but it does have a stated value of $2. Now, I've said to you that the par and stated work the same way no matter what you're doing. It's either going to have one or the other. So you're going to go ahead and write down your cash, and you're going to write down your common stock as your accounts. Fill in your cash amount. You already know how much money you're going to be getting. It hasn't changed. It's the 32,000 shares times $9 a share. So your cash is going to be a debit for 288,000. And then your common stock says number of shares times par value. You can change the word par and put in the word stated. Because remember, par and stated are exactly the same. So in this case, we're taking 32,000 shares times the stated value. And in letter C, the stated value is $2 per share. So 32,000 times 2 is going to give you 64,000. Now, you know from your stuff, you have to balance. And if you do not balance, you're going to use the additional paid-in capital account. The additional paid-in capital account, again, it's very easy to figure it out. You're going to take the 288,000 and you are going to subtract the 64,000, So 288 minus 64 leaves you a total of $224,000. That amount is going to be your credit for additional paid-in capital. And then what I want you to do is just go back and double check to make sure that the 224 plus the 64 gives you the correct total of 288. Now, not every question is going to have the same numbers, but the concepts and how you figure out your numbers will be exactly the same. Okay? Now, if you take a look at sale of no par value common stock, that's literally from your question problem. Says sold shares no par are stated. That was letter A. So go find out. Letter A says sold shares no par are stated. That is literally exactly the journal entry that you would do for the sale of no par value common stock. It's cash and common stock, no difference. So with that being said, I want you to listen to the slide over. Your example problem here. Now, I am going to post a homework assignment for you with 2 sets of journal entries for common stock to do. There's an example problem at the top of the page. And the example problem at the top of the page is exactly the problem that we just went over doing what we just did. So you really have 2 problems to do. They're all pretty much explained the same way. And again, use the information from your slides to get those done. Okay? So I'm going to go ahead and I will be sending you an email giving you all the information you guys need here in a few minutes. I do have to do a couple things outside of work here, but I will get this stuff out to you today. And we will keep moving forward. Any questions? Again, let's get them asked.